everyone, welcome to another lesson from Lesson Up Squad. Today we'll be doing part 4 of Notes to Financial Statements. If you have not watched the other videos, I highly recommend that you watch the other videos. This video will go more in depth regarding Notes to Financial Statement. In our previous lessons, we've learned how to do the income statement, balance sheet, notes related to the income statement and balance sheet, as well as we've spoken about adjustments that are not in books but directly on the face of our financial statement, and we've learned how to do various adjustments. In this lesson, we'll be learning some more example of adjustments not in the books but on the financial statement, adjustments on the income tax, adjustments for dividends, salary omissions, provision for bad debts, and interest capitalized versus interest not capitalized. So let us look at common entries on the financial statement but not in the books, which means that we do not process a journal for it. We are either just splitting an amount or we are moving amounts, but we are not using a journal to do the transaction. So here we have a first example. This is a posted check given to a creditor. So this is a check that you've made out to a creditor that only relates to the next financial year. So you can't take the check away from the person you've given the check to. You can't reverse the check because you've already made out the check, but it's in your books. So what you need to do is you need to add back the amount to the creditor's control and add it to the bank, or subtract it from the bank if you have a credit balance, because it's money that has not yet left your bank account, and it's a balance that is not yet that you've completely paid your creditor as of yet. Another common example of entries on the financial statement and not in the books is the long-term loan. A long-term loan means it will be repaid after 12 months. If the adjustment tells you that a part of the long-term loan will be paid within the next 12 months, that must be the part that you subtract from the long-term loan and show it separately as a short-term loan. So for example, long-term loan has a balance of 100,000, 20,000 will be repaid within the next 12 months. You need to split the 100,000 into 20,000 and 80,000. 80,000 being your non-current and 20,000 being your current. Another common entry on the financial statement, not in the book, similar to the loan, is the entry of the fixed deposit. So a fixed deposit is usually shown under financial assets under the heading non-current assets in the balance sheet. It means that this money will be paid out by the bank only after 12 months. If the adjustment tells you that a part of the fixed deposit will mature, which means that it will be paid within the next 12 months, that part must be subtracted from the fixed deposit amount, as this amount will be received soon. This cash amount will be then shown under cash and cash equivalents. Here we have an example of a fixed deposit. Balance is 100,000, 20,000 will be maturing within the next 12 months. In this case, the 20,000 that will be maturing in the next 12 months form part of your cash and cash equivalent note. The balance of the 80,000 Rand goes under your balance sheet as non-current assets as a fixed deposit. Another common example is a debtor with a credit balance. A debtor with a credit balance is a creditor, and that's how you should see it. Even though if the question tells you it's a debtor, you should see it as a creditor, and as such you should rather put it under trade and other payables, and if you have a creditor with a debtor balance, you should put it under trade and other receivables. Let us now talk about the income tax cycle. So if you're running a company, you have to be registered as a company and you will be paying tax to SARS. And at the beginning of the financial year, which is at this point, you will start your business, and about 6 months later, you will be making your first provisional payment to SARS. At this point, the payment that you've made to SARS is just an estimate that you've made to SARS for what you should be paying to SARS at the end of the year. At the end of the financial year, you'll make a second provisional payment based on the profit you have for the year now. At this point, it is also an estimate, and you will now submit a tax return. About 7 months down the line, SARS will then issue you a tax assessment and will tell you what you still owe them or if they owe you a refund. You will see the two important terminologies used during the income tax adjustments is provisional tax and SARS assessment. Provisional tax means it was based on an estimate, And SARS assessments means a formal document that comes from SARS to tell you what you owe to SARS or what SARS owes you. So, if your estimate, which is your provisional tax paid, is less than your total tax due to SARS, it shows a credit balance. Therefore, that will be part of your trade and other payables. You need to pay SARS more. But if your provisional tax, which is your estimate you paid, was more than what SARS actually has to tax you, then you would receive money from SARS, which is an asset, and therefore will be formed part of trade and other receivable. Here's a quick example where you've received an assessment from SARS of 180,000. So this is SARS official document that's telling you that you owe them 180,000, but you've paid them during the year 175,000, which means you still need to pay 5,000 Rand more. Therefore, you will see that your SARS income tax account is 180,000, which is the amount that SARS will say that you owe them. You will also see that this amount will then form also part of your trade and other payables. That is because it's still a liability at year end. Therefore, you will only show the 5,000, which is the liability, and not the full 180,000. You've already accounted for 175,000, which you've paid. 5,000 is still to be paid. Therefore, it is showing as a liability. In this instance, you'll see that you've received 180,000 Rand income tax SARS assessment. This is what SARS is telling you that you need to pay. You've paid 190,000 Rand. So you see in your general account, you've got your balance brought down of 190,000 Rand. Your actual SARS assessment that you've received is only for 180,000 Rand, and you've got 10,000 Rand. This 10,000 Rand is to be received from SARS, and therefore it will form a part of your trade and other receivable notes. Be mindful that this 10,000 Rand is the only amount that forms part of your trade and other receivables, and not the full 180,000. SARS will not pay you back the full amount. It will only pay you back the extra that you've paid them. In your income tax, in your profit and loss income statement, in your income tax line, you will, however, show 180,000. In this line, in your income statement, you will always show the amount that SARS says. The amount that SARS gives you to pay is the final amount that you have to pay to SARS. Let us now move to the adjustment for dividends. So when you're adjusting for dividends, there's two important accounts. One, the shareholders for dividends, and one, the dividends for ordinary shares. It's very important that you understand what both these accounts do so that you do not confuse yourself. The shareholders for dividends is a liability account. It holds anything you have not yet paid to your shareholders. Therefore, this is a liability, and therefore I call it a liability account. Dividends for ordinary share, on the other hand, is a nominal account. It has everything that you've paid and everything you have declared. Whether you've paid or not paid, everything that you've even declared would go through dividends for ordinary share. Let us now look at an example of a company that has declared dividends and also a company that has already paid dividends. So if you look here, you've got a Sun company who has 60,000 shares issued at 1.2 million Rand. They've got a dividends on ordinary share 12,000 Rand balance. This balance would be a debit balance. When you're actually paying dividend, you're taking money out of your capital. So you're reducing your capital. And when you reduce your capital, you would debit it. So this 12,000 Rand will be on the debit side of the account dividends on ordinary shares. At year end, you've declared a final dividend of 50 cents per share. So I want you to listen to what I'm saying now and listen to it very carefully and maybe note down these journals. When you declare a dividend, you would debit dividend for ordinary shares and credit shareholders for dividend. Your shareholders for dividend is your liability account. Right. Now you have to pay this dividend. You would then debit your shareholders for dividend, which is your liability account, and you would credit your bank. In essence, you've actually completely eliminated your liability when you've paid. I'm going to repeat this. So your first journal entry would be debit dividend for ordinary shareholders when you declare the dividend and credit shareholders for dividend. When you pay the dividend, you would debit shareholders for dividend and credit bank. Now, in our example, you can see that we've brought down the balance of 12,000 Rand. This is the dividend and ordinary share that was already paid and declared. We've declared another final dividend of 50 cents per share, which is 60,000 shares times 50 cents gives you 30,000. So we've debited the dividends for ordinary share account and credited shareholders for dividends, which is our liability account. In our retained earnings, we would have our balance at the beginning of the year, which is usually given to us, our profit for the year that comes from our income statement, and dividends. Dividends in the retained earning will be both what is paid and what is declared. You can see we paid 12,000 and we've declared 30,000, and both of these should form part of our retained income note. Additionally, the shareholders for dividend, the 30,000 Rand is yet to be paid, and therefore this needs to be included as part of our trade and other payables. I'm going to show you another good example of an adjustment that can be given to you. This is the adjustment to Salary Journal. This is a critical adjustment because it often confuses learners about using the gross income or using the net salary, and learners are unsure as to which one to use. And today I'm going to help you understand why you should use gross salary or net salary. So in this example, we have an employee that was left out of the Salaries Journal. The owner contributes to the medical fund and the pension fund on a rand for rand basis. Here you've got all the details of the salary, and you can see that the gross salary is 7,000. We've got the PAYE deduction, the pension deduction, the medical aid deduction to give us the net salary of 5,150. Now you've left out somebody in your income statement out of salaries. So that means your salary expense is not complete. You have to add more salaries in your income statement. So here you would add 7,000 Rand. You would add the full salary expense of the employee, because this is the full amount that you pay the employee. Then you would also add the pension fund contribution and the medical aid contribution. This is the part that is the employer's portion. The reason this is the employer's portion, because the employee's portion is paid out of the employee's money. It is not an extra expense for the company. The employer's portion is an extra expense for the company and therefore needs to be added to the pension fund contribution and the medical fund contribution that was not complete. I hope that makes better sense now. Trade and other payables on the other hand. So when you're actually paying the medical aid and pension fund, each employer does not go to the medical aid or the pension fund to pay the amounts individually. The company will consolidate both the employee and the employer portion and will then pay it to the medical aid or the pension fund. As such, you can see that both the employer and employee's portion needs to be included in trade and other payables because it's both the portion. Unlike the expense that only includes the employee's portion, what you need to pay to the funds, your medical aid funds and your pension fund, includes both the employee and the employer portion. Just to revise quickly, make sure that you know that the amount that goes in your income statement is only the employer expense. That is because the employer does not pay for the employee's medical aid, the employee's portion. The employee pays their own portion. Therefore, on the income statement, you will only show the expense what the employer has paid. But in your trade and other note payable, you would show both the employee and the employer portion because the company needs to pay both the portions together to the fund. Here I have an example of an adjustment for provision for bad debts adjustment. Remember, your provision for bad debts is different to your actual bad debts. A provision for bad debts is what it actually says. It's a provision. So just in case somebody does not pay, you've had a provision already in place. So this is different to when an actual bad debt occurs. That's when you know that Mr. XYZ specifically has not paid. That's an actual bad debt that has happened. A provision is more like of a preempt to think that 5% of my debtors are not going to pay, and therefore you already make provision in your income statement to show the users of the financial statement less profit, because you do not want to show them that you're going to receive this money when you know there's a good chance of you not receiving this money. So here you've got adjust the bad debt provision to 5% of the outstanding debtors. Bad debts are 300, provision for bad debts is 700, debtors control is 16,000. So, if you need to adjust the bad debts to 5% of the outstanding debtors, you firstly need to calculate what your outstanding debtors is. So, you've got 16,000 Rand is your debtors control, but you know that of that 300 Rand is already bad debt. So, you actually don't have that outstanding anymore. You've only got 15,700. And of that 15,700, you would now multiply it by 5%. This is what your bad debt provision should be. Your current bad debt provision is 700. Therefore, you need to increase your bad debt provision by 85. You will see under operating expenses, you would actually say provision for bad debt adjustment, increase of 85. Remember, you've already got a provision in your books for 700. So you don't want to increase it by 785. You want to increase it to 785. Therefore, you've got the difference between 785 minus 700 to give you the 85. You will see the impact of that in your notes. Under your trade debtors, you want to show your users of the financial statement that you're not going to receive the full money. You're going to receive the 16,000 Rand of debt minus the 300 minus the 785, and that is your total net trade debtors that you are expected to receive. Let's look at the loss adjustments for this lesson, which is your loan where interest is capitalized. Last week we did an example where interest was not capitalized. Capitalized means where the interest is added to the loan account or to the fixed deposit account. So capitalized means where you're adding it on to the existing account. In this example, we've got interest is capitalized, the balance of the loan is 50,000 and there's equal repayment of monthly installment of 900. So if you know that your opening balance is 50,000 and you know you've paid 900 per month for 12 months, which you've paid 10,800, and you've got a closing balance of 45,000. You would know I'm a big fan of the T account and I would use the T account to solve it. I'd bring down the balance of 50,000. I would have the bank repayments of 10,800 and I would have my closing balance of 45,000 which I was given. This helps me to automatically calculate my interest, which is 5,800 for the month. We could use this method because interest is capitalized. We could use a loan T account to solve it. If we did not have, if interest was not capitalized, we cannot necessarily use the loan T account to calculate the interest that we would like to know for our income statement. So today we've learned very much important things such as the adjustment of items not in our books, tax adjustments, dividends, salary omissions, bad debt provision adjustments, and interest capitalized versus not capitalized. If you guys still are unsure about anything, please don't hesitate to reach out. That's all for today, guys. Thank you so much for watching. Hope you guys have learned. If you still have any questions, please feel free to drop me a mail, subscribe to our YouTube channel, follow us on Instagram, feel free to ask questions in the WhatsApp group, and most importantly, please share this initiative with all your family and friends so that everybody can benefit. Thank you once again so much for listening. Until next time, bye-bye.